All right, welcome everybody to Real Estate After Hours. We have a special guest today, Andy Soloaga. Soloaga. He is a farmer's agent. We're going to talk a lot about everything that's going on with the fires, everything that's coming out into the insurance world as a result of the fires. But tell me a little bit more about yourself, Andy. You are, first and foremost, this is now your parents were in the business as well, in the real estate business as well, and you are now on the insurance side. Tell me a little bit about your history.
Correct. Grandparents. I'm first generation American, right? Family's Cuban. Grandparents were realtors. My parents actually met because my grandfather managed a real estate office that my other grandfather was a realtor at. Actually, my grandma and my grandfather were realtors at. From there, obviously, my dad even did loans. My mom always did real estate. So I grew up actually processing the loans. How I got to insurance, it was funny. While processing loans, I was always trying to just figure out how to make extra income. When I got my insurance license, and honestly, not only did I see the opportunity, I really if you would have known me while I was going to college, I was pretty set on being an attorney. I don't know why. I thought law was it for me. The one thing I love most about insurance is now that I sell contracts that actually protect people from attorneys. So something that I enjoy doing. It's honestly a rewarding business because insurance, 19 years doing this. I know that saying farmers has, right? I know a thing or two because I've seen a thing or two. But it's true, man. In just 19 years, anything you thought was impossible, it's possible.
I can only imagine.
Everything you thought you never would see happen has happened.
I say the same thing about loans. Sometimes I'll tell people, they ask me, how quickly should I expect my house to appreciate? Well, normal appreciation is about 4% per year, 4 to 5% per year. But then I follow it up really quickly with, I've never seen a normal year yet.
Yeah.
It's been very few of the last 18 or 19 years that I've been in the business where I've seen a normal year. I can only imagine the last 5 or 6 years for you in your business has had to have been a crazy roller coaster ride.
Yeah, insurance has gotten a little more intense. It's gotten a little more challenging.
Yeah.
That's for sure. I mean, I kid you not, there was a time, June 2023, where we were told by farmers they weren't sure if they were going to continue doing business in California.
Oof.
So you can imagine, it got real stressful then. And, but, I think we've all been riding the ups and downs of insurance over the last few years. That's why we're here to discuss that. But things, the outlook is looking positive. Things are looking good. Farmers now has no intent to leave California.
Good. That's really good.
Yeah, as a matter of fact, it's actually reopening. It's actually it's back into being in a positive position.
Excellent.
To offer our insured.
So they've kind of figured it out, and they're going to move forward with new plan.
Figuring it out. Yeah.
Okay. So along those lines, let's talk a little bit about. So right before we started talking, I wanted to get right into the fires and the effect of the fires. But you reminded me that, guess what? It wasn't just the fires that kicked this thing off. This has been an ongoing conversation since much before the Eaton fires and the Pacific Palisades fires.
Correct. I mean, if you're paying for insurance, right, which is all of us, we've seen the drastic changes in our rates in the last 2 years.
Mm-hmm.
We're seeing a lot of non-renewals, a lot of our homes. Even though I've been insured with a company for 20 years, all of a sudden, out of nowhere, they're now requiring me to provide proof of this, or long story short, they're going to non-renew me.
Yeah.
A lot of carriers have decided to vacate, leave the state, no longer offering coverage in California. So yeah, it's been quite challenging.
I bet. And so, there was, I remember, talk of the potential for fires. Remember, I remember that. It wasn't just that all of a sudden these fires sprang up and nobody would have imagined. No, guess what? People did imagine. People were kind of preparing along those lines. Insurance was already changing prior to the Eaton Canyon and Pacific Palisades fires. Insurance companies were already changing their stance based on what could happen that eventually did happen. Correct?
Correct, right? And I mean, it's so to kind of take a few steps back, right? Back when I mentioned in 2023, right, farmers gave me this weird announcement. At that time, this wasn't a farmer's insurance issue. It wasn't a State Farm issue. It wasn't a Mercury insurance issue. It was actually like an industry issue.
Yeah.
So to make it easier to understand, right? Insurance companies, if they were donut shops, it was costing them on an average $1.20 to $1.30 to make the donut. But because of regulations in California, they were forced to sell the donut at $1. When these insurance companies start losing 20, 30 cents out of every dollar they collect, right? That translates into billions being lost. And people are like, oh, Andy, you know, these insurance companies have had so many years where they've made a ton of money. They're finally having, you know, some bad markets, and now they're panicking.
Right.
Well, the panic was the losing so much money that seriously they were facing either having to leave the state or go bankrupt. I mean, look at State Farm. State Farm is still shut down for homeowners. State Farm on their, non-renewing all their apartments. They're non-renewing all their landlord residentials that are 4 units or 3 units.
Wow.
Yeah, and why? Why are they taking this extreme action? It's because if they keep it on the books with the amount of money that they're losing on the product, they'll go under. I mean, they were, State Farm is the largest insurer in our nation, and they were being downgraded just recently to a B rating. This is unheard of.
That is crazy.
And now, to help everyone understand, so how did it get that bad? I mean, I'm paying a fortune, and this is what I hear from everybody. I'm paying a fortune. I've never had any claims, Andy, right?
Because I think most people are going to look at their insurance and say, well, so long as I maintain my end of the bargain, which is really maintaining my home.
Yes.
In the case of people who are close to brush fires, they're keeping their perimeters. They're doing all the things that they're supposed to be doing. They feel like I'm maintaining my end of the bargain. Why should my costs go up? But
Correct.
Insurance, by its nature,
It's a pool of money.
it's a pool of money. You have to understand
More
you're
they pay.
putting money in with all the rest of us, and if it gets more expensive for the person or the entity managing that money to maintain a policy because of the risk level involved, now we're all talking about higher costs for all of us.
Correct.
It's like, unfortunately, maybe a bad comparison, but what I hear often from people who live in condos, their HOAs went up. Guess what? The HOA didn't go up just for the one person, went up for everybody because you're all pooling money together to maintain it.
Correct. And I mean, and to get to dissect real quick, right, briefly, how did it get that bad? How is it possible that the donut's costing $1.20, $1.30 to make, and it's being sold for $1, right? So to kind of, I mean, today I know this is about obviously homeowners, right? And lending and real estate. So I'm going to focus more on the property side of the insurance, right? But to go briefly on both, right? Auto and home. On the auto side of things, think of right now, we have more distracted drivers on the road than ever before. It's statistically proven, right, that it's safer to drive drunk than drive in text. Anytime I drive anywhere, I'm guilty of it, right? Every time I'm seeing the car in front of me swerving. Evidently, we're all on our cell phones. And the bigger problem in California currently, right? I mean, everywhere you go, anytime you turn on the radio, anytime you turn on the TV, everywhere you look, there is a personal injury ad. So statistically, every other accident has an injury attorney involved, right? Some of them, obviously, with a lot of them frivolous. Let's just state it like that, right? And so to the insurance company right now, I have clients saying, Andy, I'm paying $10,000 a year on auto insurance for 2 cars. It's ridiculous. Like, right? I mean, and the truth, right now you're seeing it's costing more to insure the car than it is to lease a car, right? But why is it $10,000? Because to the insurance company, honestly, the way they're looking at it right now, with the severity of accidents being up, right, because of distracted drivers, let alone inflation, the cost of repairs as magnitude. Remember, the vehicles on the road today are a lot more expensive. They have a lot more technology. The cost of repair is a lot more because of all the computer components now. So the way the insurance company is looking at it is, yeah, we're taking your $10,000, but we're going to hand you a backpack with your policy limits, and we'll throw in cash for the value of your vehicle. And if tomorrow or this year you get involved in any little incident, there's a good chance that the majority of the cash that's in this backpack will be depleted because of obvious, injury attorneys and what we have to do to defend our clients. So that's kind of just a quick little kind of like a quick little indication of what's happening on auto insurance now. Property insurance, right? Severity of claims is up tremendously. It's one factor. Why is severity of claims up? You think, you work with a lot of realtors. If you ask these realtors, the average home that in our area that's being sold, when was it built? Between 1940s, 1950s, 1960s, and even 1970s. Okay, so out of all these homes that are being sold, how many people have actually replaced plumbing? How many people have gotten rid of their galvanized plumbing? How many people have changed the electrical panels? We're talking about, we're in a world now where everything's electrical. Everything is being charged, right? There's more use for electrical components than ever before. Roofs, right? How it's been 30, 40 years. Have you changed your roof yet? No, not yet. So that's really the problem. These insurance companies have never been intended to be people's warranties. They've always been there to be there for hazards. But the problem is, with no one maintaining the properties, claims are up. And now the insurance company is someone's warranty. Meaning my house is old, my plumbing is old. All of a sudden I have a pipe burst. We have to replace the flooring. Oh, wait, this flooring doesn't exist anymore because it's 30 years old. Now the insurance company has to remodel my house. And so that's kind of one of the factors, obviously, number two, with obviously severity of claims being up, you're dealing with, we're all experiencing it, right? Inflation from, I think, the years 2019 to like 2023, the inflation rose like something like 47%, something that was ridiculous, right? Cost of materials is through the roof. Cost of building is through the roof. Cost of labor is through the roof. So now to the insurance company, remember, they're regulated. They're restricted on how much, because California is a consumer-friendly state, so they can't just double your rates, triple the rates. They can only take rate increase on small increments, right? And so we're dealing with a lot more claims, but now the claims costing a lot more than ever before. But the real factor that's hurting the insurance companies, and I know a lot of people argue with me, Andy, this is a political thing, but climate change. So climate change, we're learning is real in the sense that the changes in climate is obviously, look at in California, we are witnessing wildfires get stronger and worse than ever before, right? The recent wildfires have been the strongest in history, and they continue to get worse. Yeah. What's causing that? Obviously, climate change. We're getting no rain in California. It's giving us the conditions where these wildfires, going into Florida, right? Hurricanes. I remember when I was a kid, I had family that lived in Florida, and anytime a hurricane was, and this was every blue moon, right? A hurricane would come, they'd come to California. But now Florida's getting hit annually by 2-3 hurricanes, right? The severity of these.
Yeah, it's not just that they're getting hit much harder.
Correct.
And that's their version of what's going on in our state. Our version is, okay, there were always wildfires. It wasn't like wildfires are new to us. If you've been around long enough, you've seen many, and many per year sometimes. It's the severity of those wildfires that are affecting obviously the amount of damage, the amount of total cost, and then the insurance company, which is the mechanism that's supposed to be there to backstop us as the consumers.
Correct.
That mechanism is now overtaxed. And so if I'm understanding you correctly, the explanation is that it's overtaxed, but because of the regulatory environment in California, it's unable to keep up, or was unable to keep up with the cost associated with repairs, replacement, et cetera, on homes that might not have been upkept. In a perfect world, 20 years are up, new roof. Your galvanized is now showing wear, replaced for copper, et cetera, et cetera. Not everybody was doing that.
And that is why a lot of people are getting those letters from their insurance company saying, hey, we did a recent inspection, your roof looks old. Either replace your roof or we're not going to insure you.
Yeah, it sucks. I know people that are getting those letters, yeah.
And the crazy part about it is the policy already protects the insurance company from paying unnecessary wear and tear claims on the roof. But why are they being so picky? Because they feel that home, right, that has the bad roof, that's the home that's statistically going to have the larger plumbing losses, because if the roof hasn't been upgraded,
everything else
the systems for sure haven't been upgraded. So that's why they're making the decisions that they're making. And going back to remember, the catastrophes around the nation, weather catastrophes, hailstorms, worse than, large tornadoes, more tornadoes than everywhere. Texas, how many times is Texas now being flooded and with hailstorms? So with these weather catastrophes, all these insurance companies, they have reinsurance, meaning like for these wildfires, right? These insurance companies buy insurance for the large weather catastrophe losses. But the problem is reinsurance, which was something that was used irregularly, is now being used so regularly.
Explain to me what reinsurance is.
Basically, it's the insurance it's like basic catastrophe losses. For example, these wildfires that we just witnessed, this is considered a catastrophe loss. When we have a tornado, that's considered a catastrophe loss.
It's the insurance for the insurance?
Correct. On only the catastrophe losses.
I see. So let's say that
something that's going to cost the insurance company easy $400 million in losses, or just like now, $8 billion in losses.
So
right?
what happens? We have our insurance that we pay for. We pay into that pool of insurance.
Correct.
That covers our house against XYZ type of damages. But if you have a catastrophe that comes into play, you as the insurance company,
they rely on the reinsurance.
Are insured as well.
Correct.
Against stuff like that. So there's some pool of money behind that.
Exactly.
That I would imagine you pay into as well,
Exactly.
or you companies pay into as well. That comes into play only when there are major catastrophes.
In the year of the Paradise Fire, and this was a statistic that was told to
the
me.
fire that wiped out the city of Paradise.
In that year, farmers paid, I believe it was like $400 million for the reinsurance, and they paid out $4 billion in losses. So the need of the reinsurance is there, and so these reinsurance companies being used frequently, now doubled the rates to the insurance carriers.
Yeah.
So the carrier, because of regulation, can't double the rate to you and me. So that's why they get into that position.
We're in
where
a situation
now they're
now
losing 20, 30 cents. And one of the factors before these wildfires just changed that, right? These last wildfires just changed this.
These two, the Eaton and Palisades.
Yeah. So in the past, insurance carriers, when they went to California to the Department of Insurance to ask for rate, they were able to argue the obviously the severity of claims,
Mm-hmm.
and they were able to argue the inflation to get rates.
Mm-hmm.
But the factor that the state wasn't allowing them was the reinsurance cost. They weren't allowing the carriers to consider, or they weren't allowing, the carriers to consider the cost of the reinsurance, because to the state Department of Insurance, they were like telling the insurance companies, well, that's optional. You don't need to be paying for this reinsurance. That's optional. So we can't we can't use that as a reason on why you need to increase the client's policies. But now, after these fires,
does it seem so optional now? Those people, of course not.
Well, it obviously led to the state shutting down, and now the Department of Insurance is doing what's necessary to get all of these carriers to reopen.
Okay.
One of the big changes that happened, which you could look at it as being a negative or a positive. Negative because, yes, it's going to factor in our rates, what we pay for insurance, meaning now the insurance company is allowed to consider the rising cost of reinsurance into the rate changes. And why is this important? Because, in the high fire zones, the cost for reinsurance is so high that now the insurance carriers have the opportunity to properly charge in the areas of high exposure. Areas of high wildfire, the likelihood of a fire loss is 10 times more likely.
But let me ask you something. This is a question that's been on my mind. I'm sure it's on the mind of a lot of people. Those folks, and I know we just said we all pay into a pool of insurance. That's the nature of insurance. That's what insurance is, right? Everybody pays into a pool so that when a tough time comes for one of us, that you pull money from that pool. And so, is there going to be a all the way through effect on us? Like, I don't live in a high fire zone. I don't live in a high danger fire area. How badly are my rates going to be affected if we're now going to factor in their costs all throughout the pool?
Well, in some of the areas that are not high fire, there's still going to be rising rate. There's still going to be rising rate increases because, like I said, the insurance company was regulated for so long, and for the first two factors that I mentioned, right, there's still the inflationary issues and the severity of claims issues. So that increments for obviously the need for rate in those areas. But yes, high wildfire areas they're going to be targeted as more of a threat.
They're going to see
and
a
their
higher level of
prices,
insurance.
which is kind of scary because, right now, if you're living in one of these high fire zones and all of a sudden, and I'm having this happen in some situations, you're living month to month, right? You're set on your bills. You're paying right now $3,000 a year on insurance. All of a sudden, that $3,000 became $12,000.
Yeah,
at renewal. And I'm telling you, you're living month to month, and all of a sudden now your mortgage payment's up $700-800 because of
not the mortgage payment, the total payment,
the total payment because of the escrow
Right.
impound account, right? And so in a situation like that, I mean, I've had some clients even reach out to me and be like, Andy, I don't even know how I'm going to be paying my bills.
Wow.
And yeah, so those are some of the stressful situations in these high fire zones.
When I reach out now to get a quote, which I do more often now from the insurer. It used to be simple from a loan officer perspective to say, okay, this is about what insurance is going to land at. It was, obviously never an exact thing until we got the actual quote in, but you used to be able to gauge, right? And so you would say, this is an approximation of what you might be paying on insurance as you send out your estimate. That was the habit. Now the habit starts, for me anyways, is more along the lines of, let me reach out to insurance ahead of time, ask what they might charge on a situation like this, and quote that out as part of the initial estimate rather than wait until we got a quote legitimately once we're deeper into the
see
escrow.
if we're even going to run into any issues insuring the property.
Also, yeah, because
the prior owner made 3 claims. His roof leaked. He filed a claim. He got now, there's some people that think the insurance companies cover almost anything, right? So they sometimes just make a claim as an inquiry. Hey, you know what? This is happening at my house. My fridge broke.
That's not an insurance thing.
Seriously, but people file claims for that, and that even though it's not a chargeable claim, meaning the insurance company isn't going to raise your rate as a result to tell you, no, your fridge is not covered. That stays on the record as a filed claim. So the way the market is,
it does.
Yeah.
Oh wow.
For up to 5 years.
So
just for the inquiry, right? And it'll show up as a claim and 0 paid, and then it's that. And why is that an issue at the moment?
If the person that owns the house, let's say I'm a new homeowner.
Correct.
I just bought a house from somebody who was doing that. My fridge, my laundry, my things that are not insurable for house, the type of insurance that you do. They had these quote unquote claims, but nothing was ever paid out. That's still going to be a strike against the house that I'm buying?
Correct.
Wow.
And if let's say you're the client that made all those claims, and then you're out buying another house that hasn't had any claims, those strikes will still follow you as well.
It follows the house that you lived in, and it follows you as the buyer,
the claim will stay on the house, and the claim will stay on the person that moves for filing the claim. Yeah.
Sorry to say, brother, but that seems kind of excessive. Not to maybe the original homeowner who sold the house, but to the new guy. Like, what's he got? What did he do, or she that should impact his payment? Just because the previous guy was doing a lot of testing the waters.
Well, because a lot of the times, water claims, right? It's statistically known that a home that has a large water claim more than likely is going to have a second. So that's why.
Because of the age of the pipes, unless they replace all the pipes.
Or it could be just faulty construction. Like, because you got to remember, a lot of these tract homes are built so quickly. Even the homes that were built with copper, right? A lot of them, the way they soldered the copper, it wasn't soldered right. So you had a lot of issues where eventually where it was welded, eroded to the elements of this, because of elements of soil.
Okay. I don't want to get too technical. That to me is fascinating. Let's move on to something that I wanted to ask about is, the mindset obviously of your average insurance client right now is not, there probably is a bigger question mark over their heads when it comes to how is insurance going to be true. Tell me not so much about the technicals, but what is their mindset? Like when you talk to people who are inquiring about insuring a new home purchase, what is it? What kind of questions are they asking? What is their mindset like overall?
Well, overall, I feel, right, the insurance my entire life, no one likes to pay for insurance.
Yeah, of course.
I personally hate to pay for insurance, and I sell it, right? It's something that no one likes to do, is pay for insurance. And so that then you're adding on all these extreme changes, all these hard underwriting, all these drastic price changes. So the mindset of the consumer right now is actually, I would say, low, like me low. Meaning insurance is sadly not at the moment people's best friend.
So, but
I feel a lot of it is because people are unaware. No one's being explained. Like right now, when I explain to a customer everything that I'm explaining here, instantly everyone's like, "Oh, I get it. That makes total sense." No, I mean, I obviously don't like the fact that I got to pay more, but at least you help me understand why. My other agent that I just came from was just saying, "Well, this is the new price. Take it or leave it."
This is just what it is,
yeah,
right?
with
right.
no explanation.
But I think that's what we're trying to do.
Changing.
What we're trying to do here today is kind of have that why piece answered.
Correct.
For the consumer out there, because it's the consumer and the realtor that's going to be watching this video. Those are the people that I want them to at least know the why behind it. You can say why because of the fires. No, it was a thing before the fires, and you could say why because insurance companies are greedy or whatever we default to. But guess what? Insurance companies have to do math just like you on your home. You have to budget out what you're going to spend. Insurance companies have to do the same thing. So. I kind of even personally sitting here, I'm understanding a little bit more, and we've actually talked about this in the past. How would they be better served? Like, what are the right questions to ask an insurance agent right now that not just helps me understand, but helps me to focus on maybe what's the right level of coverage for me, and if there are cost saving pieces to that, what are the cost savings? That can be had? Like, what ideas are there for cost savings?
Okay, so I mean, there was a lot of questions on that. Cost savings, obviously, when it comes, I mean, coverage is important.
Sure,
coverage is super important. There's a reason why these insurance companies, they're involved in so much litigation that farmers doesn't even want to sell umbrellas anymore. Meaning, what's an umbrella? An umbrella covers excess liability in the event that I get into an accident and I injure someone. And now they're suing me because I for someone's lifetime disability, right? I have something that protects me and that's gonna protect my assets. Because remember, the insurance is here realistically not just because we have to pay it, but to save our assets, right? To protect us. Meaning, if you're dealing with clients, right, that have multiple properties, tomorrow they get into an accident,
right?
Their limits aren't sufficient. They have to sell properties or they got to refinance, right? To pay off.
They have to do more expensive things to cover their upcoming loss.
So evidently, always work hard to make sure you're properly insured.
Right.
Because realistically, that's how you're going to save money. That's the real way how we can save you money. Now, but how can you save money? One, looking into, bundling options, right? Merge your auto home life. Take advantage of the bundling savings. Number two,
bundling, just for those people that don't know, that's when you take, instead of being insured one company over here for the house and one company over here for the car, one over here for whatever other types of insurance you might offer, you take all of those and you put them together, and the one insurer is likely to give you a better deal.
Correct. Number two, sweat the small stuff. What do I mean by that? Meaning, speaking on behalf of a homeowner's policy, right? A lot of the times I have people that want a $500 homeowner's deductible on their homeowner's policy, and tomorrow they'll have an $1,100 issue, and they want to make that claim. And the way I always tell people is, you want to sweat the small stuff. You don't want to get the insurance company involved for a few $100, because remember, like we just discussed, any claim you file is going to result in 3 years of a surcharge. So if you're going to make a claim for something small, you're going to end up paying us more than we even paid you. And it counts as a claim against you. Now you try to sell your house, that's going to be something that's used against you. Sweat the small stuff. I mean, right now, I feel the standard deductible that I'm selling a lot on homeowners policy, it's $5,000. A lot of times I have, it sounds high, but a lot of times I'm like, Andy, you know what? I want to have only California Fair Plan. I only want fire. I want nothing else. The problem I feel with having fire only is you're only protecting, unless you're in one of these high wildfire zones, and California Fair Plan is what's needed, right? Because it's your only option. You got to look at it as out of all the exposure you have, that fire policy is really only protecting you for a 1% chance of what may occur.
Right.
For example, in big areas like Big Bear, Lake Arrowhead, right? There you have no choice. You have to get Fair Plan. But a lot of people make the mistake and don't buy what's called a companion policy or a difference in condition policy. Andy, what's the difference in condition? What's a companion? It's basically your homeowner's policy excluding fire. And then here comes Fair Plan to offer that fire.
So for those that don't know, when you're in a high fire area, California Fair Plan is like the insurer that will take on that type of policy right now in SoCal. And a lot of the major carriers will not cover where there's a high propensity for fire for that reason, right? So because they're risking losses. California has its own pooled funds that will cover you in that case. But a lot of even underwriters won't just take California Fair. Like the people on our side, when we approve loans, sometimes we'll get a California Fair quote, but the underwriter will say it's not enough. You're not covered for X, Y, and Z. All you're covered for is fire. And if you do a California Fair.
And honestly, that's because of awareness. And that's why it's important to understand. Like, think about it. You just bought a cabin in Big Bear. 2 years ago, we had a situation where there was this extreme downpour of snow.
Yeah.
I don't know if you remember, tree branches were falling everywhere. A bunch of trees fell on roofs.
I don't know.
Fair Plan does not cover falling objects. So if one of these tall trees falls on the roof of a cabin, that's not covered by the California Fair Plan.
So you have to cover your butt in other ways to make sure that your
pipes freeze. That's not covered by California Fair Plan. The weight of snow collapsed the roof, which happened also in Lake Arrowhead not too long ago.
What I'm hearing is bundle. Don't sweat or do sweat the small stuff. In other words, if you're thinking of making a claim for something that's relatively low cost, handle that yourself, because then that claim can follow you.
Yeah.
And if you live in a high propensity fire area, definitely think about that wraparound coverage. The rest of it that's not going to be covered by California Fair.
If you're actually in one of these high fire areas, know that the probability of your home catching fire is 10 times more likely than the standard home.
Okay.
So there's a high risk exposure.
I think there's a lot of people in Altadena that might have disagreed with you prior to the fires, and now would say, yeah, if my house caught fire, a lot of houses can catch fire.
These are the areas that are going to be expensive and already are kind of expensive to insure. So what do we want to do in times when it's expensive to insure? We want to start cutting coverages. Don't cut the coverage. Go up to a 20 insure, because it's almost like I'm insured for $1 million with a 5,000. I mean, this is all lines, right? Between loss of use, personal property, my structure. I'm covered for $1 million with a $500 deductible. Might cost the same as having $1.7 million in coverage with a $25,000 deductible.
Oh, wow.
But if a total loss occurs, the client's gonna get 1.56, an extra $500,000 just by being smart, getting the exact coverage they needed for a total loss, and then just having a high deductible.
It brings me to my next question. Is like I know a lot of homeowners who set up their homeowners insurance and think, well, there it is. I don't have to touch it ever again. I am insured. Is that the right way to see your homeowner's insurance?
No, you should always be reviewing it. And the reason being is not all carriers, some do, some don't, but not all carriers. Remember, cost of construction has gone up so much that what it costs to build a house 10 years ago is substantially less than what it costs today. So if you are with one of these companies that does not change your limits, you do not do a review, all of a sudden you have that fire happen, and all you have, you cannot build the house based off today's.
Right. So it is very possible,
and you have to build yourself a smaller house.
My understanding is that this is some of what's happening to the folks in Altadena right now, is that they might have been insured, they might have had an insurance policy, but that policy had not been updated in however long, and so now they're getting a check. They're getting the check for the amount that the insurance company had promised based on their policy, but guess what? That check is not enough to rebuild their home.
Correct.
So they're moving on to other places.
And another factor that people didn't consider, and even me, that I didn't really consider, because I had the opportunity where I did have some victims, but at the same time, I became a resource. A lot of people, hey, I know a guy, victims of the fire were calling me just to pick at my brain, right? I became a resource. And one of the things that I learned having a discussion, because I remember I was speaking with a gentleman that had a total loss, and he had a good policy with State Farm, like good policy. And he's like, look, right now I'm living in a family member's house. We don't want to take the money yet for a rented house. And I was like, we're still wearing the same clothes we've had on for the last 3 days. Everything was lost in the fire. We don't have any clothes. And keep in mind, when you're insured with a good company like State Farm or Farmers, On the spot, they're giving you checks to go out and get yourself some clothes, right?
Right.
On the spot, they're giving you checks to check yourself into a hotel. And I was more or less confused as to why this gentleman wasn't taking advantage of that. Because, instantly I'm always guiding people. You need to go. And he's like, no, Andy, the situation is, and he thought of it a lot more. And this was just days after the fire. He's like, the wildfire is so bad that we're hearing that it might be 3 to 4 years before we're actually able to rebuild this home. Insurance policies have loss of use coverage. What is loss of use coverage? Is in the event that my house burns down. Remember, I still got to pay my mortgage payment, but it gives me money so now that I can live in an Airbnb. Like it pays for my Airbnb for me and my family so I can still make my mortgage payment and not lose the house. Typically, that loss of use is only 12 months. In some premier policies, it's 24 months. But even having 24 months, the guy's like, I'm going to be out of my house 4 years. There's no way in hell I have enough loss of use. So he's like, the way I'm looking at it is I'm going to take all the hand-me-downs for clothes. I'm going to live with family for as long as I can. So that way I can apply all my limits towards my loss of use. So that was even my eye-opener.
He's basically pocketing all of the loss of use coverage so that he can...
pocketing the money for the personal property and pocketing the money that's supposed to be used even instantly for loss of use. So yes, to save it for hopefully being out of the house for 4 years. Yeah. He doesn't want to lose the house. He starts to pay that mortgage payment.
Right,
he stops making that mortgage payment. He loses the house.
I have already spoken to at least one client who is crammed into a home right now with, I believe, her father or her parents, and they're basically living in the living room while they're not. They were getting checks, and they were already in a position to be pre-approved, but they're definitely not replanning to go back to live in Altadena. They don't have the budget, nor the total amount coming to them was never going to be enough for them to stay. So their plan is, as these checks come in, and they are coming in, to take that money and go
correct.
Basically set up camp somewhere else.
There's still a lot of unknown variables, right, with all the fires. A lot of people are still figuring things out because remember, one of the biggest deficiencies with California Fair Plan is the max coverage it offers is $3 million. That's all limit. So that has to be between your loss of use. That has to be between the reconstruction cost of your home. And obviously, that was the big issue in Palisades, right? Most people needed 10, 15 mil of coverage. They only had 3 mil. Andy, why did they only have Fair Plan? Well, years back, these insurance companies were already forecasting, hey, our premiums are way too low and these losses are getting worse. And tomorrow we can, easily we can lose the Palisades. So farmers, believe it or not, 3 or 4 years ago, they already pulled out of the Palisades. We non-renewed what we had there, right? That's why we weren't in such a bad position like State Farm is now. At that time, State Farm, all the companies, Farmers, Mercury, all the companies were forecasting that potentially there could be a large disaster that can bury these insurance companies. And at that time, State Farm was more like, well, I think you guys are being a little too conservative. You guys are, while all the carriers started backing out, they were doubling down. They started eating up more of the market share. They started taking on the risk that people were dumping. When they finally realized that they were overexposed because of all the variables we mentioned earlier, they started non-renewing. But to non-renew, it's a 12-month process, right, to get out of everything. They were only like 6 months out of non-renewals when that fire happened. So, yeah, they were overexposed in that loss. I mean, this is based off things I read. California Fair Plan, remember, California Fair Plan, that most of the people had Fair Plan. Their total exposure out of the Palisades Fire was $3 billion. State Farm was $8 billion, and they only had reinsurance for $4 billion. So that means they were eating a $4 billion loss,
even with their own insurance.
Yeah.
Wow.
So that's why they're shut down for a little bit. That's why they're continuing to non-renew policies. It's not that they're trying to be the bad guy. It's just that they're really in a bad financial spot.
For State Farm in particular, they have this now as of yesterday. They got approved for a 22% rate hike.
Yeah.
Correct? Is that across the board for all of their clients? Or
it's on average. So it's on an average of 22%. So there's going to be some customers that can get 8. There could be some customers that get 60.
But it is going to be across the board on some level.
But that's honestly, they're portraying as a bad person, but why is farmers open right now? Why are we able to off coverage? Because we were the last big carrier, right, to shut down in California. So the state as a condition to stay open, they allowed our rate to flow. Our premiums are probably between 70 to 150% more than they were in 2022 today from 2022.
Wow.
And so you're hearing 22% and it sounds like a lot, but you're going to see it's going to be a lot more than that.
Wow.
They need more than that. It's not enough. Like even you're seeing these new prices with California Fair Plan and these fire zones, and you're almost blown away. And the crazy thing about it, it's still relatively low. It's still too low, really. It's not enough.
And still, insurance is so necessary. And the fires probably underline this even more. Insurance is as necessary now as it's ever been. And it's just, do you see a future where this levels off again and like, people's incomes catch up with cost? Or is it just going to be this news of increase for the foreseeable?
There's always going to be a point where they get to where they need to get, where they can operate properly. Obviously, I feel long-term wise, right? I personally feel that insurance will socially change. In order for it to be affordable for us, it has to socially change. Because right now you can make a claim if I lose my iPad,
Right.
But I think insurance is going to change.
You're talking about like the mindset of the consumer has to change around what they think insurance is for.
Well, yeah, and only
I see.
And also insurance is going to only be there for the large major stuff. That's how it's going to be affordable. If they stop paying out dumb claims on, oh, my garage stopped opening, or oh, my iPad's lost, and they're just there to pay the big losses, right?
Right.
The big catastrophes. That's how it's going to be more affordable. Shining some light on technology and how technology, something that I'm seeing that can potentially change the cost of insurance nationwide. So Farmers right now is requiring on all homes older than 30 years. Farmers is open, right? But if the home is older than 30 years of age, they require a whole house leak detection device. This is a new device. It's only been out for like two, maybe 3 years. We've been requiring it now for 12 months. What is it? It's a simple device that attaches to the main. It's like a 20-minute install from what I hear, right?
Right.
And the system is designed to basically automatically shut the water off in the event of a pipe burst.
Right.
40% of all homeowner claims are water losses. Water losses are, believe it or not, the insurance company's biggest fear.
Right.
So talking to our leadership, I'm learning that this leak detection device is extremely effective. Effective to eventually, when we have enough data and enough people signed up for it, what we're being told is the consumer that has this installed, the premiums will be probably about 40, 50% less than the neighbor that does not have it installed.
Yeah, because the risk level is going to be much less for somebody's going to be able to shut off their water immediately.
Thinking of the bigger picture, right? If, right now in the real estate transaction, right, homes have to have certain things in order for the home to close, right? Say, the water heater has to be strapped, right? Or small things. If this now becomes a requirement where I feel every home in California has this, and now we've eliminated the threat for any water claims, that is going to make insurance super affordable for all of us.
The cost of the device, do you know what the cost of the device is?
Okay, so it varies on the size of the home. If you go to buy this device yourself on Home Depot, it's like between $500 and $700. Then you go get a plumber, they're gonna charge you about another $500-600. Usually it's averaging between $1,200 to $1,600
installed.
Yeah. Farmers partnered with Moen. The manufacturer's Moen, right? Big name. Farmers partner with Moen. So through us, we send our customers a link where they can order it directly from Moen, installed at $750. Given the house is 5,000 square foot less, then there's increments where, like, if the house is between 5,000 and 7,000, it's like $100 more,
right.
so on and so forth.
If you, as a homeowner, if you tell me, hey, install this thing for $700, and it's going to save you over the course of your first year X amount of dollars, correct. And if that math makes sense to the homeowner, correct. I'm sure that's an easy sell.
Unfortunately, at the moment, the math, it makes sense on higher premium homes because there is a slight discount, but the discount is not great enough to be incentivized. The advantage of where I feel it's a benefit to have, pinhole leaks. Pinhole leaks are common. Pinhole leaks are not covered by any insurance policy. And by the time typically a pinhole leak is found, how do you find it? Because the whole wall is mold. And you open up the wall, the framing is mold. It becomes a very expensive repair.
Right.
This device is known to catch that pinhole leak. So it will start shutting the water off frequently until so that way you can
Find the problem and get it solved.
Actually figure out the problem. Why is it continuing and stuff? So there is a lot of benefits, and then to me, this is back to good news.
Yeah.
That this device to me, if anything, like if my theory is correct, right? Invest in mowing stock, because if everyone gets this, it can literally, I think, improve what we all pay on insurance. Anyway,
Excellent.
big time.
Well, let's end that on a good note. Andy, thank you very much. That was really, really insightful, man. I know I'm walking away from this thing a lot more educated on insurance. And I hope that some of you that listened are walking away with, again, more education about why insurance costs are going to go up, what was known before, what's happened since the fires, and potentially a little bit of hope in the future if things like this device come into play.
Correct. And also now, remember, when rate is starting to flow through, I know people are looking at it as, no one wants to pay more, but at least it's allowing more competition to come back into the market. The more competition we have as consumers, the better it's going to be for all of us.
Yeah, because farmers will compete against all the other carriers for the best coverage at the lowest price, the way markets should work.
Yeah.
And hopefully we get a better overall outcome down the road. Right now, it sounds like it is what it is. It's going to be tough for a minute.
It is. It's like, hey, this is the premium, take it or leave it. Or at least right now with things opening up, that's starting to shift.
Good. Excellent. That's good to hear. Well, thank you everybody for watching Real Estate After Hours. I hope you enjoyed this episode. Hope you got something out of it. Look out for us next time, and definitely follow us on YouTube.